Welcome to Market Wizard, the channel where traders learn to see the market with clarity instead of emotion. Today we're going to talk about one of the most important skills in trading: how to identify market bottoms and key areas of support and resistance. If you master this skill, you will stop chasing the market and start trading from positions of strength. Let's begin. First, understand this simple truth. The market moves because of buyers and sellers fighting for control. When sellers dominate, price falls. When buyers dominate, price rises. But eventually, every strong move reaches a point where the dominant side begins to weaken. That is where market bottoms and support levels are formed. A market bottom is the point where selling pressure begins to fade and buyers slowly take control. But here is where many traders get it wrong. They try to predict the bottom too early, and the market punishes them. Instead of predicting bottoms, professional traders wait for confirmation. There are several clues the market gives before a bottom forms. Let's go through them. The first clue is strong rejection candles. When price falls into a level and suddenly forms a candle with a long wick, it means sellers try to push price lower, but buyers stepped in aggressively. This is often the first sign that the market is finding support. But one candle alone is not enough. You want to see multiple reactions at the same level. This leads to the second clue: repeated price reactions. Support and resistance levels are created when price repeatedly reacts at the same area. Think of it like a floor. Every time price falls into that area and bounces, the floor becomes stronger. The more times price respects a level, the more important that level becomes. Institutional traders pay close attention to these zones. Not exact lines, but zones where orders are concentrated. That brings us to the third clue: market structure. A true market bottom usually forms when the market stops making lower lows. Instead, it starts creating higher lows. This signals that sellers are losing momentum, and buyers are slowly stepping in earlier. When you see a break of the previous lower high, that is often the first sign that the trend may be changing. Another powerful tool for identifying support and resistance is previous price history. The market has memory. Levels where price previously reversed often act as magnets in the future. If price reacted strongly at a level before, it is likely to react there again. This happens because many traders place orders around those areas. Now let's talk about psychological levels. Humans naturally think in round numbers. Levels like 1.2000 in Forex or 100 in stocks often attract a lot of orders. These areas frequently become strong support or resistance zones. Another clue for spotting a potential market bottom is volume behavior. When a strong downtrend begins to lose momentum, volume sometimes increases as large institutions start accumulating positions. Retail traders are still selling out of fear, while smart money quietly buys. This process is known as accumulation, and it often happens near the market bottom. But remember something very important. A support level is not a guarantee that price will reverse. Support and resistance are probability zones, not certainty. Sometimes support breaks, and when it does, it often turns into resistance. This is called a role reversal. A broken support becomes a ceiling where sellers enter the market again. This concept is extremely powerful because it helps traders understand where the next battle between buyers and sellers will happen. Now let's discuss how professional traders actually draw support and resistance levels. They don't clutter their charts with dozens of lines. Instead, they focus on major turning points. Look for areas where the market made strong moves, places where price sharply reversed. These are the levels that matter. Another tip is to zoom out on your chart. Most beginner traders analyze very small time frames and miss the bigger picture. But the strongest levels are usually visible on higher time frames like the daily or 4-hour chart. When a level appears clearly on a higher time frame, it often becomes very powerful. Now here is something that separates experienced traders from beginners. They do not blindly buy at support or sell at resistance. They wait for price confirmation. Confirmation can come in the form of a rejection candle, a break of structure, a false breakout, or a strong shift in momentum. This patience keeps them out of many losing trades. Remember, the goal is not to catch the exact bottom. The goal is to enter when the probability shifts in your favor. Let me give you a simple way to think about this. Imagine trying to catch a falling knife. If you grab it too early, you get cut. But if you wait until it hits the floor and stops bouncing, it becomes safe to pick up. Trading is the same. Patience protects your capital. Finally, always combine support and resistance with risk management. Even the best levels fail sometimes. That is why professional traders always use stop losses. Because survival in trading is not about being right every time. It is about protecting your capital and letting your winners grow. So remember these key principles. Market bottoms form when selling pressure weakens. Support and resistance come from repeated price reactions. Market structure reveals shifts in control. Psychological levels attract large orders. And patience is the trader's greatest weapon. If you learn to read these signals, the market will start to make much more sense. And you will stop trading emotionally and start trading like a professional. This is Market Wizard, where discipline meets opportunity.